Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session update for Tuesday, June 15th, 2021. What I'm going to do in this video is start out with the indexes as I usually do. Want to talk on the financials briefly. Again, been updating those on a daily basis lately, but I also want to talk on tech, XLK, the other big sector, I should say, in the S&P 500. So just want to tie those two in together, point out something that I've been noticing recently. Then we'll roll into updates on gold, crude oil, natural gas, the VIX. Probably do the VIX right after the indexes. Maybe touch on lumber. I covered that yesterday. That one's playing out so far. Commodities in general, and then a quick update on AMC. Again, just because that one's moving so much lately and broke out above that $60 level right before I started the video. So let's start here with SPY. Nothing new to report. Still above the secondary or benefit of the doubt trend line, but below the primary trend line there. Prices are really compressing, and usually from price compression like that, I don't have them on the chart, but your Bollinger Bands start to pinch. Bollinger Bands are an indicator you can use, and when they pinch, you usually get a big move once you finally break out of that low volatility range. And being that you have the negative divergence, that leads me to believe that the next break or big, next trend, tradable trend, will be to the downside. So I still maintain that posture. And the financials, which I've been waiting for quite some time, highlighting, tracking, following, can cover this almost every day since before and right after the breakdown. Nothing but red sticks so far. Another red stick so far today. Not much, only down 0.13%, but yet down again. Buyers aren't stepping in as they did in these previous corrections, and we're well past my benefit of the doubt trend line. In fact, we closed below that bluish benefit of the doubt trend line yesterday. So again, I still maintain pullback to at least that first target, 35.33, and if so, that's likely to continue to put pressure on the S&P 500. But now, so here's right when we broke down, and maybe even before and after, I made mention something I'll watch is to see if we get sector rotation. In other words, the financials had been leading for the last few months along with the industrials, while tech, the largest sector, was sucking wind and actually corrected. And so what I said, you can make a case, a bullish case, and I'd be remiss not to do so if I get the call right on the financials and we go down and correct here. If tech picks up the baton and starts to rally. Now, so far that's been the case. A few days or even a week doesn't quite make a trend, but I want to point this out. So we have 1, 2, 3, 4, almost 5, but 6, 7. 7 out of the last 8 candles were all red. So we've been heading, not straight down, but clearly down at a pretty steady pace in the financials. And then when we look at tech, nope, no, let's not do QQQ. Let's just do pure tech. XLK is a technology ETF. Over the last 1, 2, let me turn off all these lines. 1, 2, 3, 4, 5, 6, 7, 8. It's almost in reverse. You can see we have just as many green candles, other than one today, as we did red candles on XLF. So it's almost a perfect inverse right now. And so what I'm going to do is, and I like these little check marks. The bulls get a check mark there. First of all, tech is a higher weighted sector in the S&P 500. It's twice the weighting of the financials. But also remember the financials, industrials, others have broken down. So right now, this is a check for the bulls, or at least leaves an empty checkbox for the bears. We're going to need to see tech resume or head back down for the market to go down. Do I think it'll happen? Yes, I do, for several reasons, and not just because I'm trying to make it fit my narrative of an upcoming correction. But you can see that last high there was a divergent high. And right now we're pretty much at an equal high right there, and the divergence has only continued to steepen. So any marginal new high, in other words, it's been sector rotation recently since the financials have started to correct. If that continues, then sure, it's going to hold the market up, or at least prevent the S&P from falling too much, even if the financials drop. And the thing about it too, so I guess here's the takeaway, guys. Right now, at this moment, or at least since the financials broke down, It's not been, we've gone nowhere in the S&P 500. I, made a, figured it called a top on the S&P right around now last week. We're right there. Actually a hair above it. And again, I'm talking about for before the next tradable trend. In other words, I think the next 10% plus will be to the downside before we go up 10%. So that's what I'm talking about there. And you can see again stalling out because there's cross currents. Financials, industrials, some other sectors have been moving lower lately, but tech has a large enough weighting to keep it up. So that's it, guys. We need to see tech break, and the daily charts, are paint the bigger picture, but to really zero in, we look at the 60-minute charts. This is the tech-heavy NASDAQ 100 futures. Simple stuff, guys. Wash, rinse, repeat. This was a divergent low. All these levels highlighted at the time, or these developments, I should say, that gave you a correction up to this divergent high. We've started to correct, move sideways, put in a marginal. There's a marginal new high, slightly above that previous high. Only extended the divergences that were already in place at this point to right here, and you got your correction. And so that's it. Watch, rinse, repeat. Divergent low, rally. This rally right here, that was an almost equal, slightly higher low right there. And now, again, we've come full circle. Here's our negative divergence. And there's our trend line. So see, tech is in better shape, or the NASDAQ 100, that is in better shape than QQQ. But again, when you go back bigger picture on the daily time frame, which I showed you a minute ago on SPY, but you also, and on XLK, you have this divergence here. In other words, this last high right here, we're making a marginal slightly higher high in the indicators, and again, that shows better on the daily time frame. When you go to QQQ, this is what it looks like here, and my lines populate. That's it right there. There's our divergence line right there. I think you can make it out. So there, higher highs, lower highs on the indicators. Negative divergence. There's a trend line right there. That's the trend line that needs to break on the daily chart. If you want to replicate it, you come off the candlestick from the May 19th candlestick, the bottom of that one. Use log scaling. You could draw it out on a 60-minute chart. It would look like this. Yep, give or take. And like I said, I like to use it. See, and I had back here, I pointed out last time, I guess I updated the 60-minute chart. I pointed out we had unconfirmed divergence because the indicators hadn't turned back down. We needed to cross over. We never did that. So those divergences have grown longer. And again, I like to really use this 60-minute chart of the futures NQ. So that's it. That's what we need to see. And we'll certainly get a nice big fat check mark if and when this trend line on the 60-minute chart on NQ is taken out. That will give us a sell signal on the NASDAQ 100. It will also mean, if that happens anytime soon, that this breakout right here above the previous highs will have proved to be a false breakout. And as I often say, fewer things in trading are more bearish than a failed breakout. Because what happens when you break out the new highs, break above a resistance level, longs pile in, shorts get squeezed out. But then when they realize the breakout fails, you get a reversal there. The longs realize, uh-oh, I took a breakout, but it's failed, so I should sell my position, or their stop will be hit. If you take a breakout, that's trading right there. If you go long, you put a stop somewhat below. And then also the shorts will smell blood on a failed breakout and they pile in. So that's what we're watching for. All potential developments hasn't yet occurred, but that's the way I think things will play out. Now let's move on to the other indexes and we'll cover those other items that I talked about. S&P, again, weakness in the S&P, as I pointed out. Why? Because the financials breaking down, industrials, and some other things coming back down, and we're right on the line right now. This is a 60-minute chart of ES, the S&P 500 futures. Look at all these reactions. 1, 2, 3, 4, 5. And we're wedging. That's the nature of a bearish rising wedge. Prices start to compress, and it's like a coiled spring, and with the negative divergences in place, you favor a downside break, and you can see, minimum, I think we come back to there at 4206 on ES, and quite possibly more because we have the divergences on the daily chart. But those are some near-term targets if you're an active trader: 4223 and a quarter, and then 4206. RTY, small caps. I've got it here somewhere. One of these. Yep, there it is. Oh, nice breakdown. Here was that trend line I highlighted yesterday, and with a little bit of horizontal support right there. Trend line was broken, as was that horizontal support. Boom, right down to that first target, 2305, hit right now. If you're an active trader, you could certainly take profits, but I expect any bounce will be fleeting. And I expect 2305 to go. So let's just say 2300, or we'll call it 2305. We'll get nice and tight in there. Break of 2305, especially a 60-minute close, should open the door for a move down to my next targets, as you can see here on the chart. So there's a sell signal on RTY, small cap futures. And, from the breakdown of the trend line, that's already almost a 1% drop. And, if you trade futures, I don't have to tell you that, 1% is a nice, a nice move in a futures contract because they're highly leveraged. And if you don't, by the way, if the leverage factor is too much, but you want to kind of nibble and start getting into futures, they have mini contracts on the NQES. On the Russell 2000, it's called M2K. That's not a Z, that's a 2. My attempt at drawing a 2 without the proper tools. M2K are your micro contracts. Trades off these same price levels, just uses a smaller leverage factor than RTY. So you can build lots, or, if you only have enough, that's your comfort level. You can take just one contract. Cool thing about this too, one reason I like futures, in IRA accounts, most people think you can't short. It's an IRS restriction. You cannot allowed to, or not IRS. Yeah, it is. You can't short inside of retirement accounts. You can't short stocks. You can't short ETFs. You can buy inverse ETFs, you're going long, but you're actually allowed, if your broker lets you, Interactive Brokers does, if you have what they call a margin IRA, you can short futures in there. So if you've got, if that's where the bulk of your money is, you're retired, you're swing trading to, supplement your account, then, or you want to even position, let's say, you want to position for the next correction, that you can do that via futures in a retirement account. Okay, moving on. Quick update on gold. Gold, as you know, I've been highlighting this one quite a bit recently. We put in a divergent high. I'm still longer term bullish, but intermediate term bearish. Looking for most likely a little more upside in the dollar. Yesterday we hit that first target. We broke the trend line here, hit that almost to the button, about that 1848 target right there. Bounced, and then during the video in the morning I'd given you this 1876 line right there, but in the video I added a secondary resistance line and said that's about it. That's where, I mentioned an objective level to close out a long if you played the bounce trade. Yeah, hopefully you can see that, and or establish or get back into a short position. And so far so good. So I still think there'll probably be another leg down in gold, and at some point soon we'll look to get back in, on the long side. Okay, quick update on crude oil. Crude oil is pretty strongly correlated with the stock market as a whole, and if reason being, if economic growth expectations are bullish, strong, the outlook is good, stocks are going to rise, and therefore also crude oil. The stronger the economy is, more planes are flying, more trucks are running on the roads, planes, trains, automobiles, all that good stuff, demand for crude is up. And vice versa when the economy turns down, or more so expectations of future economic growth. And there are, yes, certainly other variables involved, but let's just focus here. This is a 60-minute chart. There's an uptrend line. We're diverging, so we're going to get most likely going to get a trend change, a correction soon in crude. Where to? I think at least right here. I'm going to throw out this target, swing target about 66, 63. You can of course trade USO or any of the other ETNs for crude, but so I'm looking at, from where we're at now, a little better than a 7% drop. Again, that's an initial swing target, but let's look at the big picture now. Crude's been strong. As it should. It collapsed during COVID, rightfully so. Everyone was on lockdown, planes weren't flying, ships weren't sailing, etc. But what we have here is a long-term chart we're looking at. Goes back to 2017. And this is crude oil futures, WTIC West Texas Intermediate Crude. And I'm going to show you simple stuff. You have or you had a divergent high right here. See up on the top, negative divergence right there, and then a nice drop, big correction. We dropped from, remember, I'm using log scaling. These are big moves. This is, back there you were up to about the, $75 or so a barrel, maybe a little bit above that, and this drop took you all the way back down to 42. That's a significant drop there. And then, of course, that big drop there. So here's what I'm trying to get at. Simple stuff. Again, it's a big part of my trading style. Look for these divergences. Wash, rinse, repeat. That divergent high was the catalyst for that drop. Big drop there, probably 40 something percent. That ended with a nice, clean, bullish divergence, divergent low. And then crude rallied from about 42.50 all the way up to about 65. Again, a very nice move in percentage terms. And then that ended with negative divergence. We put in an equal high there while the indicators were making lower highs, and that was your drop. So again, it wasn't if the drop in the COVID lows was completely random. I mean, what COVID was, it was a black swan event, they call that. But a correction was already priced in to both the stock market and crude oil at that time. That just the magnitude of the drop was exacerbated by COVID, as well as certain market forces that were unique to crude oil at the time due to storage constraints or limitations. Either way, look at that. Beautiful, strong divergent low. I always say that typically the steeper the divergence is, or the longer they span, the larger the drop. This was a long spanning divergence right there. Big drop. Long spanning divergence there, big drop. And then on the lows after a correction, the divergences typically don't span so long. At least they haven't for the last few years. But you can see it, simple stuff. And even that was a sizable drop from about 45 a barrel down to about 32 before that correction was over, again off that divergent high. So I think you get the point. Wash, rinse, repeat. Look for these divergent highs, and there's, what do you have? Nice clean divergent high right there. Clear negative divergence. Crude oil making higher highs, running about over 70 a barrel now, and the indicators clearly making the lower high. Now you might say, "Oh, okay, Randy, I'm going to go bet heavy crude right now, put all my money short, and hang on." Well, keep in mind that these divergences, I always say, don't always, but more often than not, do play out. And again, more often than not is not 100%. If it was, great. This would be the easiest thing in the world. But what happens is sometimes you'll get divergence like you had right here. I just want to point that out at this point. And it did play out for a correction, but not the big one. And then what happens? You push up again. You extend the divergence and another correction. And then you continue to extend it. And then finally the big correction or trend reversal set. In fact, that top right there from that divergent high, if you really held, I mean, that marked the highs in crude. That was multi-year highs, and we still have not met or exceeded that high since. So keep that in mind. Anywho, that's where we're at right now. Now on here, as you notice, I only have divergence lines. I don't have trend lines. Crude doesn't always give us, at least not on the daily chart, a very clean trend line. You could probably draw one here, right there, a little uptrend line like that, uptrend line like that. We had one there and we broke and corrected. But again, that's why I started with the 60-minute chart. I'm going to loop back to that. And so we're going to let this be our guide to get us in. And just knowing that this divergent high could be the start of a much larger correction. So we start out with the 60-minute chart. We look at 60-minute targets like the one I just gave you around 66, 63. And then we go from there. If we get close to that target, I'll analyze the longer term charts and make a decision whether to, if I am short, to cover that short and go long and maybe stay long, or hold tight, wait for a breakout and a much bigger move down in crude. So there it is. Call it a setup. The trend line is not, it's pretty clear. That was a little spike right there. That's the trend line right there. Comes off the May 21st divergent low, if you want to replicate that chart. Next up, on a related note, they don't always move together. They come out of the ground together, but the prices can vary. Let's see, natural gas is what I'm going for, and here it is. So I think there's a trade to be made. Yeah, I had this morning, and we're already starting to play out for the pullback. We were up here. It's already dropped about 1%, but I think there's more downside. What I'm looking at here, NG, natural gas futures, negative divergence right here on the 60-minute time frame, and I have pullback targets of 327 and then about 320 and the uptrend line. This is my preferred swing target. So I think there's still another 3.5% downside in natural gas. If you're interested in a quick trade there, and I would cover there, get a reaction. It could break, and then the other option too, I always say this, that's where we're likely to get a bounce. But if you think there's more downside, you're going to swing it down here to, let's say, that 290, 291 target right there. When you get close to the, down here, just lower your stops to protect profits in case you do bounce, and hold out for the bigger move. That's, So in other words, this is hitting a single or maybe a double, that quick drop, and this would be your home run. No, I'll move all the way down to, back down to 291 or so. That'd be about a 12.5% drop, a little bit better than 12 actually. Okay, and I wanted to update lumber, even though I did an update yesterday, just to talk about maybe some bigger macro fundamental impact that this might have. Okay, so I was persistent on this for a while. I'm telling you, and pointing out, and I've traded lumber for years, that you get these parabolic runs, and then you have these near vertical, drops that are almost just as strong. It's quite common. Lumber tends to go up. It's a one-sided trade, and when you're on the right side of the trade, it's very profitable. And so this right here was our most recent parabolic uptrend line break, and it's doing what it always does. It's in free fall. I'm finally making the headlines now. Again, I gave you a target. I think it's going to come back down here. I give you a couple targets, but look for these reaction lows. That first target we're coming up on now, about 9. Probably, what is that? Let me just get in there real tight. Let me grab this tool. There's a reaction high right about this level, right about 1,000 or so. And then you have one down here about 827 or so. That's another, that'd be the next and probably final target. I'm still longer term bullish on commodities, but again, we're in correction mode. Certainly in lumber, you can see it in free fall. And I can't rule it out. And I could see the possibility of ultimately working down here at about 640. Just want to say more downside. Now, where I'm going with this is, first of all, this one has probably been the poster child of this rally in commodities, the runaway inflation that we've had, because it has such a big impact, especially on the housing market. Huge cost increase, that I heard there's something like $30,000 increase on a framing kit for an average house, over, when we were here recently in just like the last year or so. Okay, so where I'm going with this is going to give the Fed, Powell right now is wiping the beads of sweat off his head, and he's saying, whoosh, one of those whoosh moments, because as I predicted, he was going to eat crow, and he has. The Fed has. They've started to backpedal on their narrative and express more concern about inflation, where before they were 100% dismissive of inflation. But I think with the hot CPI numbers, the next one going to be even hotter, because housing, I read, they only update the housing numbers, which is a huge component, rents and housing costs. Is every 6 months, I believe, that gets adjusted and factored in, whereas a lot of other inputs into the CPI are updated on a more frequent basis. Okay, where I'm going with this is, so that is going to help support Powell's belief that these inflation forces are transitory. But keep in mind, we are still well above where we were. This was pre-pandemic, right? No, I'm sorry. Pre-pandemic was right here. So you look where we're at, and lumber prices are still well above where we were. In fact, oh gosh, I just read it today. I forget what the average cost for this time of year, seasonally adjusted on lumber, is still many times higher than its average has been for years now. So I guess here's the takeaway. Again, that gives the Fed a little bit of reprieve and lets them, stick to that transitory theme on inflation. But with that being said, it is still we've got a way to go before you can say that this was an aberration. Lumber prices would have to fall back down here. So I just want to say that, and I don't think that's going to happen. I just gave you what my potential targets would be. Either way, great trade if you're in it, but there's some first support. We're going to bounce sooner or later, and you decide how you want to trade that one if you want to just continue to ride stops down. Okay, and I wanted to loop over this one, update on DJP. That's the all-inclusive commodity ETF I've been highlighting recently. And again, it shows the bigger picture as a clearly bullish trend since last year, last March when we bottomed and double bottomed down in April. And commodities been moving up, but as I pointed out, this is when you want to, at the very least, stop adding or buying into commodities. You're adding, if you want to scale into a bull market, you buy pullbacks. The most optimal place is down at the on a pullback to the bottom of the channel. And something else, I haven't talked about this recently with this one, but over the years I've covered this many times. When I recognize a price channel, I've always found that in almost every case, I'm able to put a midpoint line somewhere around the middle, sometimes a hair above, a hair below. And that midpoint line in a channel, and you can get something similar using a tool called an Andrews pitchfork, but it's easy to just draw that line in the middle, and that often acts as support and resistance. In other words, when you're below, when you're in the bottom of the channel, the midpoint line acts as resistance. Look, resistance, 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 boom, breakout. And once you break above, resistance once broken becomes support, and that usually opens the door to the top of the channel, and then you can buy pullbacks to the midpoint of the channel in a bull trend. Buy with a stop below, and if you break below, which you did right here, you go to the bottom of the channel. Resistance rejected. So you can see pretty interesting stuff, and again, it never fails to amaze me how clean some of these charts and these patterns and how well they respect that. So where am I going? Well, look where we are right now. We're testing. That was a pullback to the midpoint of channel right here. Bounce. Remember, we put in a divergent high. So based on what's going on with lumber, this kind of all ties in together. Lumber being, again, one of the poster childs of inflation lately. I think that may spook holders in other areas, those that are long in other areas, and we may see some more pressure. So I'm still, even though you can make an objective case to step in here, you certainly can, with a stop below, I think we're probably going to break that midpoint channel soon and head on down to the bottom. And again, I'm just kind of holding off right now on, I'm just more in hit and run mode as I'm showing you these 60-minute charts, like natural gas, for example, those trades there. And then on crude, like I showed you, there's the chance for a much bigger drop in crude oil based on those divergences that have been building. On that daily chart I showed you in the beginning of the video. Well, looks like I forgot to do the VIX when we were on the equity markets, but there it is. Actually, this board's a little more clear here. You have what I'm focused on is the divergence, positive, aka bullish divergence on the VIX continues to build, and the VIX is also at that, still hovering around that 1622-ish support. And I showed you recently, I'm drawing, just quick makeshift cycle lines. You tend to have these periodic intervals where the VIX, actually I showed you the other day, really the bottoms, not the tops, and they're about 2 months apart. And since the last spike right there, we're right on cue. So that would all mesh with, it loops all the way back. If you're going to trade the VIX, VXN, TVIX, those are some of the VXX, those are some of the VXX and TVIX are a couple of the short-term VIX ETNs. But it all comes back to this. You're going to need to see the NASDAQ 100 break down, and to see that, you're going to need tech to reverse, and then you're going to need to see the S&P 500 break down. We're very close. And so, in fact, the NASDAQ has its own VIX called VXN. And so if you want to trade the VXX or TVIX, really all you need to see is the S&P break down, and you should start to see the VIX go up. And last but not least, just a quick update on AMC. That's that triangle pattern right there. Remember, this was the same triangle that we had here. Extended the line, and we broke out yesterday. That was a breakout. Breakouts are bullish. And we also took out the 5160 resistance. Ran up here. I mentioned 60-ish as being resistance. We've traded on that. Let's look closely for the last few days here. Go down to a 1 minute chart. See, there it is, and boom, voila, breakout today. So that is bullish until and unless it fails. There's that 60-ish level, broke out. This is a 1 minute chart. That was yesterday, hit it. Today, hit it, pulled back. Then breakout right there. Breakout and a back test. This is TA 101. You could have gone long on the breakout. If you missed the breakout, you could have gone long on the pullback to back test that level. And so far, moving up. Now, again, I always say breakouts are bullish until unless they fail. If it fails, that's quite bearish. And so far, I'll tell you what I'm seeing. Remember, the AMC is very volatile, so don't go, wow, that's a 7% run. Yeah, that is impulsive, but it's not. It's par for the course with this stock. This stock's very volatile. Usually, ideal scenario would be to see once you broke out, this whole narrative from the Reddit group that's pushing this stock up is they're looking for a big short squeeze, and and they rightfully so. I would imagine a lot of shorts would have covered them that breakout above resistance. That's where a logical place for stop would be. So far, not a lot of follow through buying. Now the breakout's still intact, but this is the big level. Let's just call it $60. If that fails, especially if this little range here over the last few days, this consolidation that occurred under there fails, very bearish in my opinion, because as I often say, fewer things in trading and investing are more bearish than a failed breakout, because you get that scramble. Whoever, remember, with each breakout or each up in AMC, each thrust up, it's more and more that Reddit crowd, those kind of people that are jumping on this bandwagon, getting in, and it's working, they're driving the stock up. But when the buyers dry up, when they're all in, when all those, they call themselves the apes from Planet of the Apes, when they're all in and there's no more buyers left, the bids will collapse on this stock. They will just utterly collapse, because it's stratospheric fundamental or valuation levels. But right now, you can see there's huge volume in the stock, so there's still a lot of buying coming into it. But again, technicals rule in my book, and so 60 a solid break back below 60, not just a back test that comes in slightly below, but a solid break below, and especially down here below that 56 level, that should send the stock quickly back to at least, at minimum, 49.50, and more so, it would be a failure of that previous high. When you go to the daily chart here, you had that's not what I wanted. I wanted this. You had this previous high right here, and so far you're still above that. So AMC's been consolidating since. So, that's what the AMC bulls want to see, and that should, cause more pain and cause more short covering. Whereas if they take it back down below this range, that's going to be bearish. It's just going to say, look, they failed to get it to capitalize on that short squeeze, and you'll probably see more and more profit taking and the stock fall sharply. All right, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Just an FYI, we'll be out this afternoon from about 1:30 on. And if anything big happens this afternoon, I'll do an update tonight, later this evening when I get home.